Welcome to CFO Insight TV. The European crisis has meant the European banks face great difficulties in finding financing in US dollars. European CFOs have been helping themselves by issuing US bonds in record numbers. Today we'll be discussing how European CFOs should go about in tapping the US bond market. And with us in the studio is Heinz Hilger. He's the head of corporate banking for Germany, Austria and Switzerland at Bank of America, Merrill Lynch. Hello, welcome to the studio.
Hello.
How difficult exactly is it for European banks to get US financing right now?
Well, according to an ECB estimate, European banks were holding about 3.2 trillion assets of US dollar denominated assets on the balance sheet. In order to fund those assets, you either need to have a decent franchise in the US retail market to get access to the deposits, or you have to issue commercial papers and certificate of deposits. These assets are predominantly bought by US money market funds, and as we have recently shown, the levels of investments from these investors into such papers have decreased from about 39% under their assets under management down to 10% these days. So it's quite a significant dry out of this funding source.
And do you think that's beginning to affect the way those European banks are lending to European companies?
It has already started. We have seen quite some strange changes in the way how documentation is drafted for multi-currency credit facilities, such as premium margins for US dollar drawdowns or even complete limitations of US dollar availability under such facilities. That has not a severe impact on the financing capabilities of the corporates because these facilities are usually tend to use as CP backup facilities. But nevertheless, it shows the sort of vulnerability of the system.
What exactly do you mean when you talk about limitations in the documentation? What exactly has happened there?
For example, in these multi-currency credit facilities, usually you as a borrower can draw them down in any currency you want. But given the sort of macroeconomic trends, we have seen some European banks pushing for limitations of US dollar availability under such loan documentation.
It seems like this funding difficulties limited to banks. European corporates are facing a different situation. They're actually quite successful in issuing bonds in the US market. Is that correct?
That's absolutely correct. And that's basically also a certain trend which has been initiated by these circumstances, given that corporates, especially in such export-driven markets such as Germany, they do have a certain need for US dollar funding. And hence they are also paving the way towards US capital market issuances. And as we have seen in our year-to-date debt capital market volume numbers, we have already issued more bonds in US denomination from European issuers than in the entire year 2011.
Which companies are able to do that? I named a few big companies, European domiciled companies who've done that. But is this limited to the really big names with multinational operations?
Well, the predominantly qualification you would have in order to tap the 144A market, for example, is that you do need 2 ratings from the big rating agencies. Failing that, you still have access to the USPP market, and hence this market is indeed open to a quite large number of corporate clients.
But how big does your brand recognition, for example, need to be able to talk to U.S. investors to get them interested in your debt?
It obviously helps if your business model, if the company itself is already very well known to the investors. But they're also open to consider new kind of stories and then listening to first-time issuers. And hence, it's not necessarily required that you have a decent brand awareness in the United States.
If you're a European CFO and you want to go to the United States to tap into the capital market there and you face U.S. investors, what would be a typical question from those investors relating to the Eurozone crisis? Are they strongly worried about it?
Yes, I think it's a fair statement that U.S. investors are indeed worried about the European government crisis, and hence one question obviously would be to what extent the company we're talking about is indeed vulnerable to such trends. So that is a question which definitely would come up in such a roadshow.
Bond placements are usually very much dependent on a window of opportunity. and the size of that window of opportunity, how much does that depend on the latest twist in the ongoing European crisis?
Well, the news flows around the government crisis certainly dictates the windows of opportunities, no doubt about that. But as we have seen, especially end of August, early September, there are quite some good windows of opportunities, and hence, if you have a good business model, if you're sort of perceived as a strong borrower, then you will definitely find the right time to access the market at historically cheap funds.
A few minutes ago, you mentioned this year's level of U.S. financing by European companies, and it's already outpacing last year's total level.
Correct.
According to a recent estimate by Bank of America Merrill Lynch, this will, based on the current flow, reach $150 billion by the end of this year. Do you still think that's a sensible prediction?
Well, the way how we did it is basically to interpolate the sort of year-to-date issuances towards end of this year. It obviously depends on what we just discussed. Will there be enough windows of opportunities for issuers to tap those markets? But just from a mathematical point of view, just interpolating the sort of year-to-date activity, it would indeed lead to an increase of about 60% over last year's numbers. So hence, a significant increase of debt capital market activities in terms of US dollar-denominated bonds from European issuers.
One strong concern many European CFOs have when they look at the American capital market is the strong compliance requirements this can impose on them. Is that something you talk a lot about when you discuss this issue with European CFOs?
Well, certainly the issuance of a US dollar-regulated paper such as the 144A market requires a bit more preparation than a Eurobond. That's why our recommendation to our clients is indeed to start early in the process so that you can get your ducks in a row and tap the market whenever it's available to you. But it's indeed true. The process is slightly more cumbersome than the European bond market.
We are already nearing the end of our interview. I'm now going to ask you 3 questions, and I would like you to answer with a yes or no if possible. Will dollar issuance by European companies continue to rise?
Yes.
And will interest coupons on those bonds start to rise before the end of this year?
I tend to believe not. No.
And will the exchange rate continue to be favorable for U.S. bonds over the next 6 months?
Yes.
Thank you very much. Heinz Hilger, Bank of America Merrill Lynch, and thank you for watching.